There are quite literally hundreds of thousands of financial advisors in the United States today, each of them with varying levels of experience, credentials, and compensation structures that can make it very overwhelming if you're looking to hire one starting from scratch. So in today's video, I'll go over 9 questions that I think everyone should ask a financial advisor before hiring them to get the best experience possible with that relationship. I'll also answer the questions from my perspective as a financial advisor in an effort to be transparent. Hey everyone, my name is Jake Skellhorn, certified financial planner and co-founder of Spark Wealth Advisors, where we give you the confidence and clarity that you deserve with your money. So question number 1 should be, are you a fiduciary? And the short answer is yes, they should be a fiduciary. That just means that they're legally and ethically required to act in your best interest at all times. In the financial industry, there's 2 standards of care. There's fiduciary, and then there's a lower standard of care called a suitability standard. And an advisor that operates by that standard really just has to make sure that they're recommending investment solutions that are suitable for your situation. They don't necessarily have to be in your best interest. So the first question I would ask is always, are you a fiduciary? And it should be a resounding yes. Now, I wouldn't put too much weight on this. Fiduciary, after all, is just a standard. It's a law. It's a regulation. It doesn't automatically make a good financial advisor. And a theme that you'll notice among these questions is that it's not any one question that would lead you to believe that you're hiring the best advisor, but kind of a combination of the answers to all of them. So don't put too much weight on any one question here. But that's question 1. Question 2 should be, what type of clients do you typically work with? Most advisors would generally call themselves a generalist advisor. They will work with anyone who has a given financial need or money that they want to have managed. But the truth is, most people would be better served by a specialist advisor, someone who works specifically with their demographic, whether it be retirees or executives, school teachers, tech employees, whatever it might be. Advisors that work with a specific niche of clients are going to be more familiar with the specific financial problems and circumstances that arise from that demographic. So ask your advisor what type of clients they typically work with and if you fit into that bucket. So at Spark, we work with 2 main subsets of clients. We work with people approaching retirement or in retirement, so retirees or those within 5 years of retiring, and we help them with retirement income planning, tax planning, things like Social Security, Medicare, etc. Our second subset of clients that we typically work with are young, high-income earners, so people who are much earlier in their careers, not really thinking about retirement, but want to maximize their income and make sure everything is tax efficient when it comes to their financial picture. So those are the 2 niches of clients that we work with at Spark. Question 3 should be, what are your qualifications and credentials? At a bare minimum, an advisor should have a Series 65 or Series 66 license through FINRA, and that can be verified at brokercheck.finra.org. And this basically means they are registered with their state to be a licensed investment advisor. Believe it or not, you do not need to have this license to call yourself a financial advisor, so it's very important that you verify this first and foremost. I believe that's the base level you should have to be able to call yourself a financial advisor, so make sure you verify that first and foremost. On the BrokerCheck website, you may also notice other licenses here that advisors have. More licenses don't necessarily mean they're a better advisor. It just means that they're licensed to do different types of business. So for example, a lot of advisors hold a Series 7 license. That just means that they're affiliated with a broker-dealer, so one of the bigger firms that you might be familiar with, and that they accept commissions for the sale of investment products. Beyond that, certifications such as the CFP or Certified Financial Planner represents that the advisor has a base level of knowledge about all the areas of financial planning. So that would be cash flow and budgeting, risk management and insurance, taxes, retirement income, estate planning. So all of those major areas are covered in the CFP designation. Beyond that, there are more specialized designations that you may want to look for, similar to the second question. If you're looking for someone who specializes in a niche or your demographic, you might look for more focused designation. For example, one that comes to mind is the Certified Student Loan Professional. If you're someone who's getting ready to graduate and you want help understanding your different options for your student loans, you may seek out an advisor that has that designation. One caveat I will say with designations, they do mean that the advisor has a level of knowledge associated with passing the exams and studying for those designations, but they don't automatically translate to the real world applications of financial planning. So don't put too much weight on someone having or not having a designation. Again, it's a combination of all these things that we're covering here. So our answer to that question at Spark is that Christopher and I both hold a Series 65 license through FINRA, and I am a CFP professional. Chris is currently studying to be an enrolled agent with the IRS, which is a tax-focused designation. Question 4 is extremely important, and that is, how are you compensated? Advisors are typically compensated in one of 3 ways: commissions, fees, or a combination of the two. Commissions are generally related to the sale of an investment or insurance product, and they're very transactional in nature. So a lot of commission-based advisors may not specialize in financial planning or ongoing services. Since their compensation is tied to the sale of a product, they may be less incentivized to help you on an ongoing basis. So I'm not saying all commission-based advisors are bad, but just keep that in mind when you are interviewing an advisor. Second form of compensation is fees, which are generally paid directly by you, the client, to the advisor for a service. So a little bit more transparent generally. It's outlined in a contract that you will sign with an advisor saying what your fee is for their services. And it can come in a few forms. It can come in an hourly rate like you would pay an attorney, for example. It can also come in a percentage of assets under management, which is very common. It can come in a subscription fee where you pay a dollar amount every month to work with the advisor, kind of like a retainer fee. And then it can also come in a fixed or flat fee where an advisor charges a predetermined flat amount to cover all of their services on an ongoing basis. So our answer to that question here at Spark is that we charge a fee, and it is a percentage of assets under management. But we do also have a subscription service for clients who are not close to retirement or don't have as much assets built up, where we charge a monthly fee for financial planning and investment management. And then the third compensation structure is just a mixture of the two. It's also known as fee-based, meaning the advisor might primarily charge fees for their services, but also could recommend commission-based investment or insurance products. So just keep an eye out for that. A lot of the big box firms would be considered commission and fee or fee-based. So again, not inherently a bad thing, but just understand that their recommendations may be influenced by the products that they're selling. So because commissions can present a conflict of interest on how an advisor makes a recommendation, a lot of advisors hold themselves out as fee only, meaning they don't accept any commissions from third parties like investment companies or insurance companies that may influence their recommendations. So at Spark, we also call ourselves fee only, meaning the only money that changes hands is the fee that the client pays us for our services. Question 5 is, what services do you offer? There should be a clear understanding of what services the advisor is going to provide to you as the client, especially if it's on an ongoing basis. So in my opinion, all advisors that are engaging in a financial planning arrangement should provide, at a minimum, cash flow and budgeting. So assessing your income and expenses and making sure that you're allocating dollars to the right areas based on your goals, risk management, and insurance. So even though we don't sell insurance products, we still review clients' insurance coverage to ensure that they have appropriate coverage, and we may refer them to an insurance agent to get coverage. Investment management, that's optional for a lot of advisors these days. We do manage investments for our clients, but they should at least be providing advice on how to invest your money. And then things like estate planning, as well as tax planning and retirement planning. So those are all kind of foundational financial planning concepts that most advisors should cover at a minimum. And then beyond that, again, going back to the specialized advisors, you may look for someone who specializes in your unique financial circumstances, whether it be executive compensation, equity compensation. If you're an ultra high net worth and you have complex estate planning issues, you may look for that in an advisor as well. So make sure you have a clear understanding of what the advisor is going to provide to you as part of your arrangement. Question 6 should be, what is your investment philosophy? Investment philosophies typically fall into one of two categories. Could be active management or passive management. Passive is generally going to try to mirror a given stock market index or benchmark. Doesn't usually involve a lot of trading on a daily or monthly even basis. They come with low fees, typically lower tax consequences for investing in a passive investment strategy, and more predictable when it comes to how it will perform compared to its benchmark. Active management, on the other hand, typically involves a lot more buying and selling of different investments, which can cause more tax consequences. They generally have a lot higher fees, and perhaps not surprisingly, they often underperform their benchmarks. So in our opinion, passive investment management is the way to go. It's just not worth the extra headache to try to beat the market and often miss the mark. With that said, passive management still involves periodic rebalancing, things like tax loss harvesting to make sure that your portfolio is not becoming misaligned with your risk tolerance and your goals. So it's certainly not an autopilot type of investment strategy, but it really, again, comes back to the lower investment costs, lower taxes, and more predictable performance. Question 7 is how often and how will we communicate? Communication is key in financial planning. Your advisor should have a deep understanding of who you are as a person, what your goals and values are. They should be able to clearly outline how often you'll meet with them, as well as the amount of meetings for the initial onboarding process. So make sure your advisor is setting proper expectations on, again, the services that they provide, how often they'll be meeting with you, and the method of communication as well, whether they can be reached by phone, email, only in person, whatever it might be. Just make sure your advisor has a clear communication of what your communication standards will be in the relationship. At Spark, we have a minimum of 4 meetings for the initial onboarding phase, and that involves a first call just to make sure that we're a good fit for each other, to make sure, again, our expertise matches your needs. The second call is to take a deeper dive into your financial situation. We'll review all of your accounts, documents, statements, and understand what your goals are. The third meeting is presenting our recommendations to you and deciding to move forward or not. And meeting 4 is implementing our recommendations, opening investment accounts for you, making our suggestions for your action items that you have to do, things of that nature. So there's 4 meetings for the initial onboarding process. And then we meet a minimum of twice per year, once in the spring, once in the fall, to review your progress, make any changes to your plan based on what has happened since the last time we met, review investment performance, things of that nature. So we always encourage clients to reach out to us in between those meetings as well, because life doesn't happen on a specific schedule. Things happen, so we encourage you to reach out if there's anything that we should know about that affects your financial situation. Question 8 is another important one. It's what happens if I need to withdraw my funds? So first and foremost, I will say that any advisor should have a deep understanding of when you need money before making a recommendation on whether or not to invest it or how to invest it. So you should be very transparent with your advisor on your timeline for needing money, your goals with that money, etc. But the advisor should have a detailed outline of how you can expect to withdraw funds if you need to turn an account into an investment or an income stream, I should say, in retirement. They should be able to clearly outline how that process works. And they should also be able to tell you what method you can receive the money by, whether it be by check, wire, or direct deposit. Also, if there's any fees associated with the withdrawals, they should be able to tell you that as well. So make sure you understand how liquid your funds are, whether there's any penalties for withdrawing money early. Some insurance or investment products may have surrender charges or penalties to withdraw money early, so make sure that you know that ahead of time before agreeing to anything. Our answer at Spark to that question is that withdrawals are a seamless process. They can be automated for clients who are in retirement that need that monthly payment amount sent to their bank account. We typically just do it all electronically these days, but checks can be sent. There's no additional fees to do withdrawals, so we're very clear and transparent on the withdrawal process. Also, we make it clear up front as well to our clients that should anything change down the road where you decide that you no longer want to work with us, we don't make it difficult for you to move your accounts to another institution. So we don't believe in making it hard for you to leave like other companies do if things change down the line. So we're very transparent and upfront about that. And the last question that I don't think is asked often enough is, do you work with CPAs and attorneys and other professionals that I have in my life? So as a client, you may have a tax preparer, an estate attorney, or maybe a separate insurance agent that you deal with. Your financial advisor should be acting as a quarterback to communicate with all those different professionals to make sure that your full financial picture is working in tandem with one another. So, for example, financial advisors are rarely also tax preparers or attorneys or insurance agents. So you want to make sure that you are able to have that advisor communicate with those individuals for recommendations for things like tax preparation, if a will needs to be updated based on, a new account that you opened, things of that nature. The advisor should be willing and able to communicate with those other professionals that you have. And our answer to that is, of course, we do work with clients' tax preparers, estate attorneys, and other professionals to make sure that the financial plan is cohesive. So in conclusion, most people that end up working with a financial advisor work with them for a very long period of time, sometimes the rest of their lives. So it's important to get it right ahead of time. So ask these questions to an advisor that you may be thinking of hiring. It can make all the difference in the success of your relationship long term. Let me know if you have any questions in the comments, and thank you for watching.